Welcome to TMS Insights. It's November, Ben, and the markets have had a bit of a change after a good year. Obviously, market pullbacks and market rises are part of the grist of everyday living when you're in equities, and you see it all the time. But we're speaking today after a circa 7% decline from a very good peak in October of the ASX. Global markets haven't sold off as much. We want to dig today into some of those reasons and understand where it's impacting and what we now have as a prognosis. So let's go back. What's happened? The market was so robust. Could the grind up from that April tariff fear has been relentless, and it went and peaked, third week of October?
Yeah, and as we often say, nice regular corrections are a healthy thing in a market, and the longer you don't have them, the nastier the eventual correction you have is.
Yep.
So, look, I think that it feels like the thing that's caused it has been the uncertainty over another Fed rate cut, and that's been driven by the fact that the US government's been in a very long shutdown, and the markets have sort of
has ended now.
It's ended now, but they're flying blind a bit because we don't really know what the data for October is probably ever going to look like because it wasn't being collected by government workers. And the market had priced in another Fed rate cut or two. Now there's uncertainty around that. The weird thing about this correction has been the US market's still very strong. It's only a couple of percent off its all-time high. Our market's corrected much more heavily. It's decoupled in a way.
Yeah, well, our central banks sort of almost indicated pause on rates as well, but we are a smaller economy, so we get impacted more than the bigger ones often. But so what you've said there is obviously US equities, and we're holders of a lot of international shares. They've not only performed better over many years, but haven't sold off in this last window, have they?
They haven't, and once again, another reason for that has been their reporting season.
So we've got some hard data to talk about there.
Yeah, so
and in the Aussie market, it's actually a relatively quiet period. We largely have AGM season now.
Yeah,
and we'll talk about a few quarterlies and a couple of companies that don't fit into a normal reporting year and report out of cycle. So, but talking about the US earnings, we're getting pretty good numbers. There is a very big number the market's waiting on in 24 hours' time out of Nvidia.
Yeah.
That seems to
biggest company on the market these days. But if you look at the data, 85% of US companies have now reported, and 83% of those companies have beaten expectations. But it's really being driven by the Mag 7. And I actually wrote down a quote from Sam Altman, who's the CEO of OpenAI, who said, during the quarter, we are committed to infrastructure spending commitments of about $1.4 trillion US over the next 8 years.
It's committed, yeah.
Amazon, Google, and Microsoft combined have spent less than $1 trillion in capex over the last decade. So this is just one company. These other companies are also spending aggressively, and it's estimated at the moment that half of the United States GDP growth is AI spend. Yeah, they're in it. It's a different environment over there to where we're at.
Yeah, and that's not the same situation here, obviously. Yeah. So it is imperative to understand that differential. Let's say this, so Ben, it's not unfair to say the market, with its good run up, had some areas of excess pricing potentially.
Yep.
PEs were up. Yep. They ratchet back on the back of earnings issues, but also interest rate expectations.
Totally. And, I think if you go back to the start of this year, even when we were sending out the insights, we were saying then that a lot of the stocks we own were trading on multiples that we hadn't really seen them trade on before. And that's really what drove this move to reduce down our Australian share exposure and to cycle into the alternative investments that we've been talking about this year. Then we had the very steep correction, and there's a lot of good value around with Liberation Day.
Yep.
And then, sort of back to where we were, well above where we were at the start of the year. Yeah. And I'd say multiples got very expensive again. And now I don't think they're roaringly cheap, but they're definitely on the better side of fair value.
Particularly because it's the growth stocks.
It's the growth stocks.
We've been hit quite hard, really, which we'll go into a few names. And let's do the sort of analysis of that with some of the reports we've seen, and we mentioned there were some quarterlies, a couple of footy results. The numbers locally are pretty good.
Yeah.
The reactions were a bit bearish, weren't
Pretty
they?
brutal.
Yeah.
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 It's not an earnings issue. So a couple of our companies reported, Xero and Aristocrat, both came in line with expectations. We've seen some others that we don't own, like Life360, Technology One, Catapult yesterday, that actually were beating expectations and still getting hit very hard. So it was a valuation thing, and I think, you know, just a general risk off. I mean, Bitcoin's another thing we don't.
Sure, it's a good sign of the risk.
I feel like it's becoming a sign of risk proxy in the world.
So that's had a huge, 10 months of the year.
Yeah.
But it's wiped up all those gains in the last 4 weeks.
Yeah, got up to 125,000. I think it's now back at 90.
88 or something, yeah.
Yeah, so for me, that's almost become a barometer for global risk on, risk off. And it feels like our growth stocks have actually kind of followed that.
There's correlation there.
Yeah, which is weird. Not something I would have expected.
No. And so you mentioned Aristocrat. Again, numbers there were fine. The market reaction negative.
Such a consistent business. Grew its earnings 9%. No earnings guidance, as they always do. You know, there were some mild sort of quibbles that the analysts have with the result, but overall it was a good result.
Zero, good numbers.
Similar.
Again, wanting more detail about the US earnings story.
And the acquisition that they've made.
Yeah. So, I mean,
which will take a bit of time.
Well, they've only just concluded it. So,
got the keys a few weeks ago to the business. So
it's not going to show up for a couple of years.
Yeah, that's a while off.
And we don't know how that'll go, but it's they're making a big play into a big market. So,
yeah, absolutely.
The quarterlies, REA Group.
Great quarterly.
Share prices come down. That's a growth contraction and concern about CoStar's ownership of Domain now.
Yeah, and I think there is just the simmering worries about, could AI disrupt these classified businesses? It's not just REA. We've seen Rightmove, Zillow in the US, Hemnet, another one that we follow. They've all come off, and there is, you know, this sort of uncertainty of, could people start searching to purchase a house on ChatGPT?
Yep.
Or so I think that's well off, but it's not inconceivable that there's a threat bubbling away there. At the same time, REA, you know, spoke at length about how they're rolling AI into their platform, which is going to potentially
cost savings, extra benefits.
Yeah. So remains to be seen. But I think it's just, if you're trading on 50 times and you've got some of those, you know, background worries, it's not hard to trade on 40 times.
No. ResMed, good numbers, but share price hasn't taken off. Really.
No.
And valuations look pretty reasonable.
Yeah, I mean, it's one of the, probably that is one that does look cheap.
Yeah.
I think the other interesting thing this year, Jez, has been that the healthcare stocks has, again, you know, that with the RFK and Trump chaos in America in the healthcare industry, been the worst performing part of our market.
CSL dominates that, and that's obviously been a poster boy for the difficulties of the year.
Yeah, absolutely.
So and it's had a tough one.
Yeah,
but it's played through other stocks.
Yeah.
Talking about another quarterly, Light and Wonder.
Yep.
Again, they're a company which has had dual listing. It's condensing back to an ASX listing.
That's right, and I think there was a period of forced selling from the US fundies as they moved into that window, but that was actually, I think, of all those results I've spoken about, that was actually probably the strongest.
It was a bit of a beat, but the reaction was very positive.
It was.
On the
it got cheap.
Got sold off before, which is often, it's a reaction against what happened in the last period.
Right.
And talking about the global environment now, and we've made a comment about how much the US hasn't sold off. Does that now mean that that's expensive, or do we take their consistent earnings growth, which they've reported through, their Mag 7, but a lot of non-Mag 7 companies as well.
Yep.
It's been an excellent reporting season there.
It has.
Is this just a case of this term of the American exceptionalism again?
Well, it feels like it to me. I mean, if you look at the results, they were really broadly very good.
Mm.
Meta was probably the one that disappointed,
And it's been off.
and it's come off quite hard. But Meta's trading on 20 times earnings.
Yeah,
It's that
Where
it's
where I want to, and this is the point, Ben. 1 year ago, and you know what the best performing Mag 7 stock has been from a year ago, Alphabet.
Mm.
You could not have found a supporter anywhere in investment markets. It was the most aggressively talked down stock, I think, because Google search was going to be eaten alive by various chats and others. So that hasn't proven to be right.
No.
Google exists and lives, and Google search is a key earner for them.
Yeah, and Gemini is hitting its straps.
They're farming away at it. And within these incredibly innovative companies, often American, you are seeing incredible optionality about things we don't even know they could be doing.
Yep.
We get a sense, we try to get as close as we can, but they're long tail, a lot of R&D, creating the future.
Yep.
And prepare yourself for more excitement from what they're doing.
Well, if you listen to that Alphabet result, the one division that the CEO was the most bullish on was Waymo, which is Google's driverless car business. And, that's a reminder. This is a loss-making business they've been plowing hundreds of millions of dollars into. And at some point, that will turn profitable. And Tesla and Waymo will probably be the two dominant car businesses in the future.
All that says is just don't get caught too much up in the here and now, and be able to see the duration capacity of these incredible businesses.
And understand that pullbacks in their prices are absolutely normal and generally opportunities and not something to be overly concerned about. If you own the right businesses and you know the earnings are continuing to grow, they'll go through periods where they get a bit expensive and they get a bit cheap. But longer term, the share price will follow the trajectory of the earnings.
Yep, exactly. Just with what's ahead, obviously, it's not a long time in the run into Christmas. Christmas period tends to be good for markets overall. Talk about a Santa rally. Haven't had that in recent weeks, but it's still a good period of time to come. Business activity is pretty frenetic, isn't it? It's a robust local and international business environment.
Yep.
A lot's moving and changing. So what can you tell people about what's coming up then?
Well, we've got a number of AGMs over the next couple of weeks, and then company announcements will go very quiet. But you're right, this has been an unusual year. Well, it's been unusual in that normally you get a decent correction in that late September October period. And we actually saw a rise in the market during that time, and it's doing the opposite now to what it normally does then. So seasonality works more often than not, but it can work not. And I still think where we are now, we could still have that run into the end of the year. It's not inconceivable because valuations have got better.
Yep.
And we're not seeing downgrades or, we're not seeing.
No, it's a very orderly pullback. It's got the normal signs of a small corrective phase. And again, where earnings are going to be and rates are supportive, even if they're not coming down, it's a good environment for investing. So you'll get these changes, but it's normal activity. So, and normal for us. And we'll be back again with another Insights in December.